Okay, let me ask you this. If I said, just investing a pretty small amount each month could actually make you a multimillionaire, would you even believe that? It sounds a bit, well, out there.
Yeah.
Almost too good to be true. But today, we're doing a deep dive into something that makes this happen. It's the power of compounding. And our mission, really, is to unpack why starting early with this compounding thing isn't just like a good financial tip. It's probably one of the biggest, most impactful money decisions you can possibly make.
It's funny you say that because compounding, well, it's often called the eighth wonder of the world. And there's a very solid reason for that. The way it builds wealth is just profound,
Mm,
really transformative. But, so many people either don't grasp it or they seriously underestimate what it can do. So, yeah, we're here to clear that up.
absolutely. And hopefully, by the end of this deep dive, you, the listener, will get exactly how it works. And crucially, why time. Why time is the magic ingredient. And most importantly, how you can actually use it.
Yeah.
Harness it to build your own, like, real wealth. So let's start basic. What is compounding exactly?
Okay, so at its core, it's pretty simple, actually. But yeah, incredibly powerful. Think of it like this. Your money starts making money for you.
Yeah.
You put some money in your investment, right? That earns a return. And then this is the key part. Those returns start earning returns too. It
Yeah.
just keeps going. A cycle that speeds up,
Yeah.
gains building on gains.
Right, right. It's that snowball analogy you always hear. Like, over time, that snowball effect becomes huge. You start rolling a tiny snowball down a hill, it picks up more snow, gets bigger and faster.
Yeah.
And it's really, really easy to forget just how massive that snowball can eventually get, isn't it?
Oh, absolutely. It's easy to underestimate because the crucial thing here isn't just, steady growth, like adding the same amount over and over. We're talking about exponential growth. So your initial bit grows, then that new, slightly bigger amount becomes the baseline for the next bit of growth. It earns even more. It creates this powerful feedback loop. Your money isn't just growing, it's actually speeding up its own growth, like a self-fueling engine
Yeah.
almost.
Okay, yeah, conceptually that makes sense. But I think the real kicker, the aha moment that makes you really pay attention. That comes when you see it play out in real life or, with an example. So let's try that. Let's use a story, maybe two friends. Let's call them Rahul and Rohan, just to show the difference between starting early and waiting. It's pretty shocking, actually. Okay, so Rahul, he's proactive. He starts investing, say, 50 quid a month, just picking a number at age 25. Pretty young. And he does this consistently, but only for 10 years. He stops completely when he turns 35. So his total investment over that decade, just 6,000 units. That's it. He puts in 6,000 and then just leaves it. Doesn't touch it.
Okay, then there's Rohan for number two. He does things differently. He waits, doesn't start investing until he's 35, the age Rahul stopped. But once Rohan starts, he's pretty diligent. He invests that same 50 units a month, but he keeps going, nonstop, all the way until he's 60. That's what, 25 years of investing? Much longer. So his total amount invested is way more than Rahul's. It comes out to 15,000 units.
Right. So Rahul, less money, fewer years, started early. Rohan, way more money, much longer time investing, but started later. And let's just assume, for this example, they both get the same return, say a decent 12% per year on their investment. So standard assumption. Okay, brace yourself for the results, because this is where the magic of compounding just smacks you in the face. By the time they both hit 60, Rahul's investment, the one he stopped feeding at 35, it's grown to roughly, wait for it, 176,000 units. Astonishing. And Rohan, remember, he put in more than double the money, invested for 2.5 times as long. His pot grows to about 144,000 units.
Wow. And that just lays it bare, doesn't it? The incredible, undeniable impact of time. What's just staggering here is Rahul put in way less cash for way fewer years, but just because he started earlier, he ends up with significantly more money. It feels wrong, almost counterintuitive, until you dig into the why.
It really does feel like magic. It's bizarre. Rahul puts in 6,000, gets 176,000. Rohan puts in 15,000, gets 144,000. So what is going on there? What's the secret sauce? Why does that happen?
That's the million-dollar question, isn't it? And the answer is baked right into how compounding works. Rahul's money, see, it had a whole extra decade, that crucial time between age 25 and 35, for its first returns to start earning their own returns. That 10-year head start meant the returns on returns effect kicked in much, much earlier. It started building momentum, quietly at first. So even when Rahul stopped adding new money, the pot he had built just kept growing, exponentially, because those early gains were working hard, compounding year after year without him doing anything else. Rohan, well, by waiting, he missed out on that critical early phase, that period where compounding starts slow but then really ramps up. It's just a really stark example of how time isn't just a factor, it's like the ultimate multiplier.
Yeah, and that brings us perfectly into digging deeper into the why. Why time is just everything, the ultimate amplifier in long-term investing. It takes us back to that snowball analogy, doesn't it? The earlier that snowball starts rolling down the hill, the more time it has, more time to gather snow, gather momentum. It goes from being a tiny thing to this huge, unstoppable force. And it's not just a small difference either. Every single extra year, especially early on, it makes a massive, disproportionate difference.
That's spot on. And it's honestly not hyperbole to say that waiting even 5 or 10 years to start investing, it can literally cost you hundreds of thousands, potentially millions in wealth you could have had. Those first few years, yeah, the amounts might seem small. You might not feel like much is happening day to day, but that's exactly when you're laying the foundation, the groundwork for that huge future growth. Because you're giving the compounding effect more cycles, more time to work its wonders. It's like planting an oak tree versus a tomato plant, right? The sooner you plant the oak, the bigger it gets over the decades.
And just to put a little bit of math behind it without getting too technical, the basic formula for compound growth, which comes up in the sources, is future value, P times 1 plus R, raised to the power of N. So let's just quickly break that down. P, that's your principal, the money you start with or put in. R is the rate of return, the percentage growth each year. And N is the time, the number of years your money is invested and working for you.
Now look closely at that formula, px 1 plus rn. What really jumps out, it's the n, the time factor. It's an exponent, which means even small increases in n in the time lead to really big, nonlinear jumps in the future value, sometimes surprisingly big jumps. And this math perfectly explains our Rahul and Rohan story, why Rahul's early start, even with less money put in, gave him such a better result. Which leads us to that famous saying, doesn't it? That time in the market almost always beats trying to time the market.
Yeah, I hear that phrase all the time. Time in the market beats timing the market.
Mm-hmm.
But, for a lot of listeners, it feels tempting, right? Trying to guess the perfect moment to jump in, or maybe worse, pulling money out when things look shaky. How does that connect back to this in factor?
Oh, it connects directly. Trying to time the market, predicting the lows to buy and the highs to sell, it's incredibly difficult. Even the pros struggle. Most fail, actually. What usually happens is you end up missing the best days in the market, often the recovery days after a dip. Or you sit on the sidelines during strong growth periods. And doing that just messes up the end. It breaks the chain. Every time you're out, you've essentially hit pause on your compounding clock. Being consistent, staying patient, letting your investments just ride out the market's ups and downs over the long term, that almost always gives you better results than trying to be clever and predict the unpredictable. Rahul's story, again, he just stayed put after his initial 10 years.
Okay, so we get it. Compounding is powerful, time is critical. So the big question is, how do we actually do this? How can you, listening right now, put this compounding power to work effectively? The sources give some really practical, actionable tips. First one, start with whatever you can. Seriously, even if it's just like £5 a month or $50, whatever, the message is loud and clear. No amount is too small to get the ball rolling. The main thing is just to start, like today.
Absolutely. Couldn't agree more. That initial amount, it's way less important than the act of just beginning. Those small, regular bits you put in, they build the base. And then compounding takes over, especially if you have decades ahead of you. Don't let the thought that you need a big chunk of money stop you from making that first step. Just start.
Second tip, and this one's a real booster, increase your investments yearly. They call it a top-up. Even just adding a little bit more to what you invest each month or year. It makes a huge difference down the line because you're feeding that principal amount that's already compounding. You're boosting both the P and letting the N work on a bigger base. Third, stay invested long-term, don't withdraw early. This loops right back to N in that formula, doesn't it? Patience. It's like the golden rule here. You have to let the snowball gather snow. You can't keep taking bits off it.
Exactly right. Every time you dip in, every time you pause contributions, you're basically hitting reset or at least slowing down that exponential curve significantly. You need to let those early gains properly mature, become part of the new principle that earns more gains. Yeah, it takes discipline, resisting the urge to use that money for something else short term, but that patience pays off big time.
Fourth tip. Avoid chasing short-term gains, let compounding work. Trying to jump on hot stocks or make a quick profit, it often means more risk, more trading, and it can just completely disrupt that steady compounding rhythm you want. And the last one, be patient. Compounding is slow at first, but explosive later. This is about managing expectations, isn't it? Reminding yourself it's a long game, a marathon. You need to stick with it even when the first few years feel, well, a bit underwhelming.
Totally. Those early years are planting years, not harvest years. And if you tie all these tips together, they all point back to the massive importance of time, that end factor. Starting small gets them going right away. Increasing investments boosts P and leverages and more. Staying invested keeps them running without interruption. Avoiding chasing protects an NR from unnecessary risk and costs. And patience. Patience is just accepting how exponential growth works. It's quiet at first, yeah, but then it really does become explosive later on, especially as you get closer to your goal, like retirement.
Okay, so we know what to do. Just as vital, though, is knowing what not to do. The sources point out some common mistakes people make that really sabotage this whole compounding process. Number one, and maybe the costliest, waiting too long to start, procrastination. Like we saw with Rahul and Rohan, delaying by just a few years, let alone
Sure.
10. The cost is huge, millions potentially. You just can't get that lost time back. It's gone.
And it's worth asking why it's so costly, right? It's not just that you miss putting money in, you miss the chance for those very first investments to compound over the longest possible period. Those initial years are when the returns on returns engine first fires up. Missing them means you chop off the early accelerating part of that growth curve. Psychologically, yeah, it's easy to say, I'll start next year, but financially, it's incredibly damaging.
Another big mistake, stopping investments during market crashes, or even selling. This feels so wrong to many people. Your gut screams, get out, when the market tanks.
Mm.
But you're saying that's actually the worst thing to do.
For a long-term investor focused on compounding, yes, it absolutely is. It's a critical point. What people often miss is that market dips are actually opportunities. They're sales. You get to buy more shares, more units of your investment for the same amount of money. So if you keep investing through the downturns, what they call buying the dip, you're essentially snapping up assets on discount. Then, when the market recovers, which historically it always has, eventually, not only do your old investments bounce back, but those extra units you bought cheap, they supercharge your future growth. Stopping or selling in panic, that just locks in your losses and guarantees you miss the recovery and the accelerated compounding. It's tough emotionally, for sure, but staying invested or even adding more is the smart financial move.
Okay, wow. That's a powerful perspective shift. And the final pitfall, constantly switching investments. Chasing the latest hot fund or jumping between strategies because something else looked better last quarter.
Precisely. Every switch often means you realize gains or losses. You pay transaction fees. And crucially, you interrupt that beautiful continuous compounding cycle. Remember, in the formula. It loves uninterrupted time. Constant switching means no single investment gets the long runway it needs to really take off exponentially. It really requires sticking to your strategy, having some conviction, and letting your chosen investments do their work over years, even decades, without constant meddling. Chasing performance often leads to underperformance compared to just staying put.
So wrapping this all up, if there's just one single thing, one core message we want you to walk away with from this deep dive, it's that compounding truly is like your money's secret superpower. It's this invisible force, but unbelievably powerful, that can turn small, steady efforts into really serious wealth over time. And the main takeaway, it's simple, really. The sooner you start, the bigger the potential reward. It's not about being some finance genius or needing a fortune to begin. It's about consistency. Yeah, discipline, sure, but mostly, it's about giving your money the gift of time. Lots of time. So please, really, don't wait for the perfect time. Because that perfect time, it's always now. Start today, even small. 10 years from now, maybe 20 or 30, you will definitely thank yourself for making that decision.
Absolutely. And maybe just one final thought to leave you with. Something to mull over, make it your mantra perhaps. Just 3 simple things. Start early. Stay invested. Get rich slowly. It sums up everything we've talked about, doesn't it? And it really is the most reliable, proven path to building lasting financial security.